How's it going, everyone? My name is Dan, but you can call me Malone. And a couple of weeks back, I read an article entitled How Inexperienced Investors Are Taken In by Hype. Now, this is a topic that we've spoken about once or twice in other videos on the channel, but we haven't actually made a dedicated video discussing this very important topic. Now, the reason why this topic is more relevant than ever is because in the last year alone, we've seen trading platforms such as Robinhood, Trading212, and DeGiro just absolutely explode in terms of user growth. And what this means in reality is that there's a lot, and I mean a lot, of first-time investors placing their hard-earned cash into the financial markets. The harsh reality, however, is that the vast majority of these newcomers have little to no idea what they're doing, and that's obviously to be expected because they're newcomers. Now, obviously, everyone has to start somewhere, and it's honestly great to see so many people turning their eyes to the world of the stock market and investing, because making investments early and often is a key component to building wealth, as we know. However, where investors can land themselves in trouble is when they invest on the back of hype and hype alone. So let's start the video here. The last year in the investing world has honestly played out like something from a Hollywood movie. In March 2020, you have the widespread outbreak of the virus, the global economy goes into lockdown, and the S&P 500 tanks by over 30%. Fast forward 1 year later and you've the S&P 500 at all-time highs, the NASDAQ returning over 40% in one calendar year, which is one of the 5 times it has done so since 1975, and more importantly, you have more people than ever interested in investing. Couple all of this with the fact that it's arguably never been easier to invest, and you can start to see how we've ended up where we are. Now, the rapid recovery in the major indexes such as the S&P 500 and the NASDAQ is obviously a factor which has attracted a lot more people to the investing world. But the real main attraction has actually been the more speculative investments such as the GameStop fiasco, the electric vehicle movement, and the heightened interest in the likes of penny stocks. Let's also not forget cryptocurrency, which has drawn massive retail investor interest over the course of the last year. I'll put it to you this way: before 2020, I knew very few people my age who were making active investments in any sorts of financial assets other than holding cash on deposit in a bank account. Nowadays, I struggle to find anyone who hasn't at some point or another over the course of the last year invested some money in the likes of cryptocurrency or a speculative stock market play. This is not surprising to me at all, and here's why. First of all, savings rates were reported to be at all-time highs during 2020. Now, what this means is that people had a lot more cash on their hands than normal, and due to the nature of national lockdowns, they also had a lot more time on their hands than normal. With this extra time and money on their hands, people started turning to the financial markets. And this makes sense. Interest rates on bank deposits are virtually zero, and the stock market at the time was going through a fairly large correction. So what better opportunity to get involved than now? Second of all, companies such as Tesla, NIO, GameStop, Churchill Capital, and many more were relentlessly reported by mainstream media due to the fact that they were skyrocketing in price. Now, because people had lots of time on their hands, these news articles got a lot of attention. This resulted in investor interest increasing significantly, which subsequently resulted in the stock price of these companies increasing even more. I mean, Tesla gained nearly 700% in 2020 alone, and NIO gained over 1,100%. To put that into perspective, an equivalent investment in the S&P 500 would have had to be made in 1990 to achieve the same return today. So when you combine people having time on their hands, money on their hands, interest rates on bank deposits being virtually zero, and mainstream media acting as a hype mechanism, it starts to make a lot of sense as to why people became interested in the stock market this year. The issue with this, however, is that the vast majority of people who jumped on the investing bandwagon made investment decisions without considering their attitude towards risk, without considering their financial needs and circumstances, without fully understanding what it is they were putting their money into, and without having a strategy. When you do this, you have no basis to back up your investment decision when the market goes against you. And I say when and not if, because volatility on the downside is more or less guaranteed when it comes to investing. Because you've no basis to back up your investment decision, if things go badly in the short term, you're very likely to panic and sell at a loss. The reason for this is because you made an investment decision based on emotion. You got caught up in the headlines talking about GameStop going to the moon and you saw growth. green. But in doing so, you ignore the considerations which are fundamental to any investment decision. One of the biggest pitfalls of any stock market newcomer is that they fail to understand that as the price of any investment increases, it becomes more risky, not less. And as the price of an investment decreases, it becomes less risky, not more. To understand why this is, you need to realize that a stock represents an ownership interest in a living, breathing corporate entity. This entity owns assets and it earns profits, or at least you should hope it does. So by buying the stock of the company, you do have an entitlement to those assets and earnings, again because you're becoming an owner of the company. And so by and large, the stock price represents the market's expectations of how much profits you will be entitled to as a shareholder in the future. The higher the price, the higher the expectations, and the more likely it is that the company will fail to meet those expectations. So where a stock market newcomer sees a hot stock producing ludicrous returns over a short period of time, they will likely see this as a good thing, and there's a good chance that they could make an investment decision without fully understanding the risks involved. So is this newfound interest in the stock market a good thing or a bad thing? Well, it honestly depends what way you look at it. On the one hand, you now have a lot more people considering how they can make their money work for them outside of the traditional safety of a bank account. And if even a fraction of those people commit to educating themselves around sensible and sustainable investing strategies over the long term, well then that's only a good thing. However, the unfortunate reality is that the vast majority of stock market newcomers will likely end up losing money in the short term, cashing out, and that'll be that. In fact, a recent article by CNBC indicated that based on recent trading volumes, retail investors may be beginning to lose interest in the stock market. It isn't the fact that investors may lose money which bothers me, it's the fact that they may never come back to the world of investing again based solely on their one experience following hype. Some people might walk away from a silly investment in GameStop thinking that the stock market is a loser's game and is nothing more than glorified gambling. They may then pass this mentality onto their children, which can have a devastating impact on generational wealth. But in reality, it was really just their investing behavior which embodied gambling. We know it's totally possible to implement an investing strategy over the long term which seeks to preserve your initial capital investment and generate adequate returns. It's just not as sexy as the overnight millionaire fairy tale that your brain tries to sell you. The bottom line is that financial education is critical to investment success. When we educate ourselves, we lessen the likelihood of suffering the catastrophic loss. Don't be the person who YOLOs money they can't afford into a meme stock just because your best friend's cousin twice removed told you that it's gonna be the next Wall Street bets play. Stay safe out there and invest sensibly. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.